Hello, hello. Tim Clairmont here, CEO and founder of Clear Financial Partners. Welcome to another session with us for Clear Money Talk. So thank you so much for joining us today. As always, our wondrous, amazing co-host. I think I'm just going to go with wondrous. I've given you so many adjectives over the years now.
Whatever you want.
Which one's your favorite?
Yeah, we should take a poll.
We should. Well, okay. If the audience has a favorite adjective for that, actually, that'd be really cool. You should send us an email. Send us an email at team TEAM at clearfp.com. That's CLEAR, F as in Frank, P as in Peter.com. Team at clearfp.com. And you tell us, which adjective do you think best describes Tyler of all the adjectives you've seen me use over all these years, and or what your favorite adjective is, Tyler. And if you have a giant contingent of a lot of people that are just so attracted to you and they say handsome, that's fine. You could say
That's
handsome.
also fine. Any derogatory statements will be ignored.
That's right. We're just going to purge that and we'll be fine.
We'll go from there. But it's good to be here. It's always fun. We always have a good time with the podcast. And I got another exciting topic for Tim. As you all know, Tim comes in not knowing what the topic is. I prepared in advance, come up with all of our fun talking points to give you guys the most as listeners for the meat of the podcast. And we just have a good time going back and forth answering money-related questions that it seems like all the world and everybody out there has. And frankly, a lot of them I even have. I do a lot of learning too by just generating these podcasts and talking through with you guys. So you ready to dive in?
I'm ready. I don't know. I'm the only one in the dark here. So what's the topic of the day?
That's right. You are.
What's the topic of the day?
Topic of the day is: are you too reliant on your employer for financial security? Are you too reliant on your employer for financial security?
Well, clearly the answer for Tyler is no. He should be completely reliant on me for financial security for the rest of his life, because there's no other option for you, Tyler.
You see these handcuffs?
Yeah,
they're golden.
Right. That's right.
Solid gold.
That's right.
I don't mind them.
You're going nowhere. So
I think this is a great topic to talk about for many different reasons. But I think the biggest reason that this is an important topic is 401ks are so prevalent these days, and also employer equity, like employer stock, whether vested or unvested, all the different forms of employer stock and equity, and also a lot of the insurance and other benefits, fringe benefits that come along with your employer, whether it's disability insurance, life insurance, health insurance, all those things. And the big question is, what happens if something happens to your employer or something happens to you in your employment? What does that look like for you from a financial security at retirement or just financial security pre-retirement with everything else going on?
Yeah, it's a really smart question, actually.
Yeah.
It's worth noting, because a lot of times I feel like when something does happen, your employer, like we had a client contact us the last couple of weeks. Their employer went belly up, and so the client's no longer employed. Nothing they did, the employer's gone. And then, of course, many other times, people can be terminated, whether it's for cause or whether it's just being let go or downsized. There's people that lose their jobs, and if you're really dependent on your job and it just goes away and you haven't given any thought to what now, it can be even more distressful when that situation occurs than it would have otherwise been had you been prepared for the eventuality of you leaving your employment. I mean, that is what financial independence or retirement really results in at the end of the day. At the end of the day, most people leave their employer. So it's not an if, it's a when. And if you don't get to control the when, then it's a good idea for you to have an idea as to what it looks like on the other side. And what it would look like if it happened suddenly and unexpectedly right now, because that does happen to an awful lot of people, and we don't know who it's going to happen to next. But let's go ahead and address it. Are you relying too much on your employer? Certainly, as it relates to retirement savings, pensions, and also known as defined benefit plans, have been around for a long time, but they're few and far between now. If you're a government employee, like a teacher, firefighter, police officer, or a handful of other private sector employees who are fortunate enough to have a pension, then that is really an anomalous, amazing benefit. Now, too many times in the past, people relied too heavily even on their pension. Your pension plus your Social Security combined are designed to cover only 25 to 40% of your retirement income most of the time. Historically, that's been the average. In some cases, the pensions have been so generous that they've gone well beyond that 40% level. Like many of our PERS employees in the state of Oregon, for example, with the Tier 1 benefits, oftentimes we're receiving well above 40% of their retirement income experience overall. But that's really rare. Most of the time, pensions and Social Security combined are designed to cover 25 to 40% of your retirement income. If you don't have a pension, then you're looking at maybe 25% of your retirement income, possibly from Social Security, and whether or not that's going to be there for us or not is a big question mark that's been there the whole time I've grown up and continue to pay into the Social Security system. For those that are Over the age of 55, I think it's highly unlikely you're going to be experiencing anything less than the Social Security benefits you're seeing. I'd be shocked. It could happen, but I think you're probably going to be okay. If you're under 45, I think you would be foolish to think your Social Security is not going to change at some point from what it is today. And I think it's likely that you'll see older required minimums and things of that sort. Anyway, I digress. That's your retirement stuff. So if you're really relying on the pension, just be aware there's probably a gap between what you're going to need and what that's going to produce for you. And if you don't have a pension, you definitely have a gap. You've got a big gap between the Social Security and what you want in retirement, and it's on you to save that up. Hence the 401k or maybe a 403b, 457 plan, some of the other equivalent terms for that. They're not the same, but they're similar in the sense that they allow you to contribute pre-tax or in a Roth capacity and build up money and then draw from it when you retire. So when you think about that, are you depending on your employer? I mean, if you're depending on your employer to make profit-sharing contributions and match contributions and you're only barely contributing to your 401k, you're probably over-banking on your employer. There's a good chance that your contribution level is inadequate to reach the retirement goals that you probably have. If you're maxing out your retirement account in your 401k or 403b or 457 plan, that may be enough. It may be more than enough. It may not be enough. It depends on your retirement goals, and you really need to do some number crunching, as well as how you're investing that money. How you're investing that money is a massive impact on the long-term size of your portfolio. Think of building up the goose that's going to lay the golden eggs. You want the goose as big as possible. The bigger the goose, the bigger the eggs. But ultimately, how much the goose can grow is a function of how much you contribute, and how you're contributing it, and how much your employer contributes. So it does take a little bit of math to project a little bit on that. Mm-hmm. But when you have other things like what you articulated, stocks and stock options, and other fringe benefits that might occur, you might have a health insurance benefit that's covered through your employer. All of those benefits have significant cost as well. I would say health insurance is on one side, stock options and stock is another. Stock options and stock, pay attention to what percentage of your overall portfolio is invested in that company's stock, because if you end up overweighted in one company's stock, you can be really have a negative surprise if that company goes under or goes down in value drastically. And then most stocks did something in between those things. They might have done well for a period of time, and then all of a sudden they come down, and you're waiting to hit some price that you hope they get back to, and in the meantime, it could slide even further down, or maybe come back. You don't know. But if you have a huge percentage of your portfolio tied up in that one stock, you may find yourself beholden to the performance of that one stock, and if it's your current employer, that's probably too much as well. So I wouldn't want to be dependent on my employer in that way. So I guess ultimately the answer is it depends, as many of the answers are to all these questions. It depends on how heavily you are allocated in your employer and how much your benefits are and what your desires are. And we can always crunch the numbers to figure out if you're distant from from being financially independent, or if you're fairly close or even already financially independent. And that can give you a lot of additional confidence. I've been monologuing indefinitely now, Tyler. And
take a breath.
You
earned it.
I'll give you a little bit of space on that. I know we'll come back still and talk about the health insurance benefits, health insurance costs. I don't want to forget that, but let's take a breather before I go there and let Tyler say a few words.
I think you did such a good job. A lot of the words I was waiting to spew, you just pulled them right out of my mouth. That was cool. I think if I could summarize a lot of what Tim said, I think diversification is sexy. Is really what the gist of this is. Whether it's diversification in your retirement plans through your employer, not being heavily concentrated in one or two or fewer positions, being diversified in your investment approach. Are you just using a 401k your employer? Are you doing other things? Do you have an IRA or Roth IRA outside of your employer that you're investing in different stuff? Are you relying too heavily on the pension, as Tim mentioned? We actually have some clients in a very large national or probably global organization that just stopped funding their pension. I think at the end of this year, they're not funding the pension any longer, but you're going to keep the accrued benefits, but they're no longer funding it moving forward, and they're instead funding, I think, the 401k in a different capacity. But that's just one example of how something that you may have been so reliant on to continue to grow and become X at this certain date down the future might not come to fruition any longer because of a decision that higher ups made for your corporation as a whole. That's just one example. Tim mentioned Enron. I think that's one of the biggest case studies in this situation possible when it comes to being too highly reliant on your employer for your financial security, whether it's now or in retirement, your financial security. I mean, Enron literally like went under.
Yeah.
They had a pension, I believe. They had, you know, stock, and people had a lot of stock in the company and otherwise. And it happened so quickly. I don't think anybody really had an opportunity to do something different than to just ride that wave and see what happens. And that's just so unfortunate. And we hate when we see that happen.
Yeah.
You know, that's an extreme example, but all we have a lot of the times in life is to go off of, you know, what we've seen happen.
Yeah.
Right.
It's very real. You know, you don't know what your short straw is or your long straw. Like I always say, when it comes to health, somehow everybody in their early 60s draws straws, and some people get a short straw and some people get a long straw. And that old concept of if you're gathering around and the person with the short straw is the one who's got to deal with whatever the negative thing is that you got to deal with. You know, if you get the short straw in health, then that's not good. You know, you get the long straw, you feel better, everything's looking okay. But it does seem like everybody draws straws in their early 60s when it comes to health. When it comes to your employment situation, you're drawing a straw, every day with your job, and whether or not you keep getting the long straw and your job's there and everything's good, or you unluckily get the short straw and get laid off or get let go or have your company go belly up. That short straw moment is one that you don't want to have hit you when you didn't look on the other side of the short straw. You need to look at what could happen, and the best way to do that is to look at your benefits, look at what's your picture look like. Do you have emergency money set aside to deal with the short-term issue, and make sure you have adequate emergency money. If you don't have emergency money, where would you go for money? Do you have a resource? Do you have a line of credit? Do you have a friend or a family member that you could borrow from? If you're planning on touching retirement accounts and you're looking at those as your emergency money, recognize that the IRS does not agree with you that it's an emergency. If you're under the age of 59 and a half and you lose your job, you're going to have a 10% penalty tax plus ordinary income taxes to take that money out. And that could be very expensive. You could easily lose half of whatever you take out if you're counting on that to deal with an emergency. So pay attention to how you would answer those questions if you draw the short straw. If you have the work short straw tomorrow, what are you going to do? Do you have a plan B? Because and if you don't have a plan B, you don't have to freak out. I don't want to. That's not my point. Just start creating a plan B and start building it up and get your liquidity going and make sure that you look on the other side of what happens when your job's over. Because when it's over, as it will be for all of us one day, you want to make sure there's enough money coming in to cover all of your desires and needs and wants and your family and protect everybody. And that gets us that health insurance comment that we were just talking about.
Yeah.
So group health is one of the huge benefits a lot of us take for granted from our employer. And if you're independent on your own and you have to acquire health insurance and you have any kind of modest amount of income or modest amount of assets, and you don't qualify for some of the group Medicaid, like being broke, government will pay for some stuff, benefits. Health insurance pre-65 can be very expensive, oftentimes $1,000 to $2,000 a month for one or potentially two people, depending on how much care you need and what your health insurance looks like. And that's just the insurance. That doesn't count your co-pays, your co-insurance, your deductibles, and all the other medical expenses you might deal with, prescription medication, not to mention out of industry or out of network alternative therapies and medications you might decide you want to pursue. The health problems with health is, I believe, the number one cause of bankruptcy in the United States. That I think I read that. I read that somewhere.
I mean, it can become so expensive so quickly if you're not properly prepared for it. And I mean, health insurance, unfortunately, is not an earned right by being alive here in the U.S. You got to pay for it in some capacity, where it's different in other countries and other parts of the world. It might be different. And you're correct with that. And life insurance too. I wanted to mention life insurance too. A lot of people are so reliant on their group life insurance plans. And although it can be a very, you have economies of scale, and it can be very cost effective to participate in those plans, usually a multiple of your salary. But a lot of the times, one, is it enough coverage? A couple, 1.5, 2 times your salary, is that enough to really replace your income and everything if something happens to you? But also two, usually it doesn't follow you if you lose your job or you change jobs or anything like that. And if you've had a health situation change that makes you not insurable, you're going to wish you had an independent policy. So that way, if you do get, if something does happen with you and your employer, that you still have coverage, especially if it's important for you and your family structure. And that's often a huge thing that's overlooked a lot of the time. Well, I have group insurance. I'm okay. I don't need independent policy. A lot of the times it's not always the case. A lot of the times you can really benefit from that.
It's really smart what you're articulating, Tyler. I mean, life insurance, I can't tell you how many times I ask clients, oh, how much life? Oh, I have it. I got that covered. I have it through work. Well, let me ask you, and I apologize for you having to think about this for a second, but I think it's important. Think about people you know who have passed away at a younger age, before the age of 60. Like most of us know somebody who has unfortunately passed away. Now, maybe it's somebody very close to you. Maybe it's somebody who's not as close to you. You have a friend of a friend kind of situation. But do you really believe that in those situations, they passed away suddenly, like in a car accident or some kind of an incident like that? If that's the case, their group life insurance through work paid out. What if they got sick? What if they got cancer or something along those lines and they didn't die immediately? They died over time. Do you think there's a decent chance that they left their employer before they died? After they got sick, but before they died. You get sick and then you leave your employer because you can't keep doing your job anymore. Where's your life insurance? It's gone. Your life insurance is only covering you until you're not employed anymore. Once you leave your employer, you don't have the coverage anymore. So having a permanent policy or a temporary term insurance policy that follows you independently, you control when you're going to be done with that policy, not your employment situation. And if you get sick and develop some kind of an illness that ultimately takes you out and you can't work up until the day you die, your group life insurance, it's not necessarily going to be there for you to really take care of your family. So just make sure you're paying attention to those things.
Yeah. Well said. Cool. I think we hit on a lot of the key components here. I'm trying to think if we missed anything. I don't think there is. I think a lot of us are guilty of being too reliant on their employer for financial security. And whether
except
that's
for you, Tyler.
Except for me.
Except for Tyler. He's totally fine. You can completely
except for me. I'm the one, the rare instance here.
That's right.
And I think that it's worth giving consideration to and at least knowing what that would look like if something happened. I think that's the biggest thing in life is like if you can at least understand what would happen if this situation unfolded or this happened, like it's at least knowledge is power.
Yeah.
So it's usually the uncertainty and the scare of something happening and then not having planned for it accordingly is what leads people to those bad situations that we hear about.
It never hurts to have a plan B. No. You may never use it. Great. Good for you. You didn't draw the short straw. I'm really happy for you. But did it really hurt you to have a plan B? Like, no. If you have a plan B and you draw the short straw, at least you know what's coming. You can deal with it. It's a lot easier. It never hurts to have a plan B.
Yeah. And that's what we do all the time. With holistic financial planning, we account for all those things. Yep. A good plan should be built to be resilient and not built for, a one-stop shop kind of a situation.
Everybody's got a unique situation. So it's all personalized. It's all specific to you. And there's a lot of different moving parts in that process. And it's hard to figure out if it's not your day in and day out job, which is what it is for us. That's how we do what we do. That's right. That's what we do. Okay, well, we got to do the just the answer. I have no idea how that's going to work. So
Tyler, good luck.
I'm going to delegate that. Good luck.
Thanks, man.
You're welcome.
Okay, just the answer for all of you listeners tuning in for the short version. Really wish you tuned in for the long version too. And if you tuned in for the long version, you're here for the short version. Very cool. You're listening to everything we have, all the content. Topic was, are you too reliant on your employer for financial security? Tim and I think are in agreement. You know what we should do is that they're always phrased as a question, right? Yeah. And it's usually a yes or a no or somewhere in between. We should have our standpoint of whether it's a yes or a no.
Yeah. Oh, yeah.
And I think in this situation, we're like, yes, I think a lot of people are too reliant on their employer.
That's fair. This is a yes
security.
Answer.
But as Tim said, I am not too reliant on my
Except for Tyler.
This
is a yes answer for everybody but Tyler.
Yes.
Okay.
So we talked about a lot of the hidden risks of being too reliant on your employer for financial security. Some people are overly concentrated in employer stock options, stock equity, things like that in your employer. Presents diversification and concentration risk as far as that's concerned. A lot of people are too reliant on a defined benefit or defined contribution plan, whether that's a pension or a 401k. Understand if you lost your job, if you had to retire early, if something happened to your employer in your employment situation, what would that look like for you from a retirement savings standpoint, whether you're already in retirement or if you're leading and planning up to that point. Just understand what that would look like. We talked about insurance and other fringe benefits that come along with your employer. So think about health insurance, life insurance, disability insurance, all those additional benefits that come along with your employment. A lot of those things don't follow you if you leave your job. So health insurance, you might have COBRA for an extended period of time, but after a while, it usually goes away. Group life insurance usually does not follow you the second you leave. It's immediately done. You have to be still working there in order to participate in that group life insurance plan. So if life insurance is critical to your financial plan, you want to plan strategically to maybe consider an independent policy that follows you no matter where you work. And then also disability insurance. If you get disabled at work, you usually have workers' comp, but if you get disabled for another reason, maybe you get sick or an illness that keeps you from being able to work, there's usually, not all the time, a lot of employers will have disability insurance plans that will still pay you a portion of your paycheck while you're disabled and not able to do your gainful employment. So all of those things can oftentimes make you very reliant on your employer, which is not a bad thing. We're not here to say that it's a bad thing. A lot of employers are there for the benefit of their employees and also their clients. And I think most employers are, but at the end of the day, they always have their bottom line and their interests usually ahead of your own. So you need to put your interests too ahead of their own and understanding what would it look like if you lost your job or what would it look like if your employment situation changed. So all this is worth giving consideration to. Just have a plan in place. The plan should be resilient and not dependent on one thing to unfold. Make sure it can weather the storm no matter what happens.
Everything you said's spot on. I think
Nice.
if you want more depth and detail on this in a valid and efficient way, I'd listen to the long version of the show. We covered it really tight. Tyler did a great job as far as just the answer, so kudos there.
Thanks.
And the bottom line answer to this question is yes. I think that too many people are too reliant on their employer. And probably everyone is. You shouldn't be as reliant on your employer as you are, except for Tyler. So.
Except for me. And we got solutions for all this. If you feel you are too reliant on your employer, talk to us. I think we got ideas and we can ideate together. It's never a come in here, we tell you what to do. It's a come in here, we talk about it, and we figure out a plan that you're comfortable with and you feel good about. So.
That's right. Yeah, schedule a clarity call. You let us know in the email when you tell us how handsome Tyler is or whatever other adjective it is that you want to assign to Tyler. But if you're interested in the clarity call, let us know. We'll connect with you and have a little 15-minute chat and see if there's something that we can do to help you out. Why don't we move on and wrap up our show with our typical closure?
A little bit of trivia.
All right. Stump the nerd. Here we go.
Stump the nerd time. I think you might get this one.
Oh, are you giving me a layup after killing me in the last three?
It's not a layup still.
Oh my goodness.
For you.
All right.
That nice.
No layup. So be it.
All right.
What do you got?
Which U.S. coin was once made mostly of silver, but has changed in 1965 due to rising costs?
Oh, I'm interesting. So, I mean, my gut would normally go to the nickel. I remember there was the nickel and everything else, and then they changed it with things. But obviously, there's the silver dollar as well, which the silver dollar itself is made of silver. I think it's still made of silver. Otherwise, they wouldn't call it a silver dollar. So, but maybe the dollar coin used to be made of silver as a coin, and then maybe they actually have a dollar coin now that is not made of silver. That actually feels true to me. I think that. As much as I think the nickel, I actually think the nickel used to be made with actual nickel, and then it was changed to something else. So maybe it wasn't silver. Let's just go with the silver dollar. I'm just going to go with the silver dollar.
I mean, it's on there as an option, but it's not the silver dollar.
Not the silver dollar. So they're still making the silver dollar with silver?
I guess.
All right. I would have gone with nickel as the second guess.
Yeah.
But
Quarter.
What is it? Quarter? Really?
Quarter.
They made a quarter out of silver?
In 1965, the U.S. Mint removed most silver from dimes and quarters, switching to a copper-nickel blend to cut costs as silver prices were climbing at the time.
Copper-nickel blend. Interesting.
Yeah.
Well, wait. If it was dimes and quarters, okay, so because it was a quarter made out of silver and quarters are bigger, is that why it was more silver? Or what was the question again?
It was what U.S. coin was made mostly of silver, but changed in 65 due to rising costs.
So the percentage was higher silver on the quarter than the dime? Because otherwise the dime could have been as equally satisfying as
well, I mean, the dime
both of which I didn't say, to be clear. Anyway, clearly, yet again, I'm on a streak now.
That's
I think it's 4 in a row of losses.
See what next week has in store for you.
So be it. So hopefully you learned along with me, as I just did. The silver in the quarter and the dime used to be there, and now it is not. Got it. But the silver dollar sounds like
Did you
it's
have one
still
of
there.
those maps, or like early 2000s, you could put the quarters based on the state and all that?
No, that came out a little bit after my time.
It's all right.
I was a little older.
Yeah, it's okay.
That was a really cool
You're never
thing.
too old to have some fun.
No, it was a
But I
cool idea.
because I'd put my quarters in there
Yeah.
and then you couldn't get them out.
Oh, you
And
can get the
I'm
quarter
like,
out?
yeah, no, like it locks it in there based on the state. And I'm like, oh man, I really want to spend that on something.
That's cool.
Get all my quarters
I
together.
bet you could probably go on the internet and buy a completed one with all of
That's
it.
cheating.
Yeah, it is cheating, but it's okay. It wouldn't be a bad thing
You
to
think it
have.
would be worth more than?
Yeah, probably on the internet.
Yeah.
a little bit more than the
It always
quarters.
is.
Anyway, we got to bring us to a close. Wrap us up as always. The long show. We want to be respectful of your minutes. Thank you so much for joining us on Clear Money Talk today, and I look forward to doing this again with you. Hopefully, very, very, very soon. In fact, you can do it instantaneously by simply jumping to another one of our shows and answering a different money-related question. But if you're just dying and waiting for the next podcast, we release one every 2 weeks, typically on Monday morning. And I appreciate you spending your minutes with us and joining us on Clear Money Talk. Tyler, any final words for the
No, thanks
listeners,
for your
viewers?
time. We do really appreciate it. So
Cool.
thank you guys all for tuning in.
Appreciate you. Thank you.
See you
Until
next
next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetera Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often, target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangui Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.